Another chart example that I would like to present to you here. In this video, I want to talk about the difference between the approach taken by an amateur trader versus a professional stock trader. So, how would an amateur trader look at the base, and how would a professional stock trader look at the same base? For example, an amateur would look at this base and ask himself or herself, should I buy this stock? Whereas a professional trader would look at this same base and would ask himself or herself, what is the amount of risk involved? I have always been telling you that for me personally, when I look at a stock, for me, it is not a yes or no decision like most other traders. They ask themselves, should I buy the stock or not? So for me, it is not a binary yes or no decision. I am looking at a stock and I'm asking myself, what is the amount of risk that I am being presented with? So, for example, if I go to a restaurant, I am being presented with a menu, and then I look at the menu and I decide what do I want to order. Similarly, when I look at MarketSmith, the list of stocks that come in my filter, that is like a menu. And from that menu, I have to select stocks. So it's a very professional approach. I look at the menu and I see what stocks are available, which are forming a proper base, and how much risk am I being presented with. And then I decide whether the stock is worth my time and whether that stock is worth my money or not. That is the approach. So, all trading is risk management, nothing else. So, you are not a trader, you are actually a risk manager. Similarly, if you are a commercial airline pilot, you are not really a pilot. You are really a risk manager. You are being trained to manage risk. You are not trained to fly the aircraft. You are trained to manage risk. Similarly, I am training you here to manage the risk because that's all you can do. Once you buy a stock, you have absolutely no control over the price of that particular stock unless you have the financial resources to influence the price of the stock, which in most cases is not true because retail participants do not cannot influence the price of a stock. The institutions do. So let us look at this base and try to find out what are the factors that are in our favor and what are the factors here that are not in our favor, all from a risk management point of view. Okay. So let us start counting the points that are in our favor in this particular base. So let me write here what are the points in our favor. Number one, have a look at the red bars 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Out of 10 red bars, how many are low volume? Almost all red bars are coming on low volume. Look here. Okay. So that is a point which is in our favor. So low volume red bar. So I will write here low volume red bars. Let me reduce the font of this. I'll make it 22. Okay. So low volume red bars, all of them. By the way, this is an old time frame chart. So this is 26th of December 2023. So as per the regulations in India, we are allowed to discuss this chart. So low volume red bars, that is a point in our favor. Next, if we look at the daily time frame chart, at this time, the moving averages are in our favor. So if I go to the daily, so this is the daily time frame chart. So price is above the blue is above the green, and the green is above the red. So this is 29 December. So we are just entering the next year, which is 2024. So the daily time frame chart moving averages are in our favor, and all the three are sloping up. So moving averages. That's a that's a point in our favor, right? Next, high relative strength stock. At that time, the relative strength of the stock was 88. So RS, so we'll write high RS, which was 88 at that time. This base, this is a cup, okay? This base was base number one. So there is a base reset here. Can you see the base reset happening here? You see this bar, after this bar, there are three consecutive bars that have come below the high of this bar. The entire bar is below the high of this bar. So three consecutive bars below the high of this bar. So that's a base. Okay. So, and this is the low of that base. And that low of the base was taken out by this bar. Normally, this is called as a shakeout bar. Normally, a shakeout bar comes on low volume. Look at this. This is low volume. And this bar has taken out this low. That is why the base reset has happened in this stock. So if you see before the formation of this base, the stock shot up from the low till the high of this. The stock shot up 225%, but that base was reset by this bar, right? So the base reset has happened, which is why this is base number one, which is a point in our favor. So base reset. So this is early stage, right? What else do you see which is in our favor? Look at these green bars. I generally don't focus on the green bars because I am more focused on institutional selling. I am not focused on institutional buying because since the moving averages are already in our favor on the daily time frame chart, it's a stock which is already in a confirmed stage 2 uptrend. Okay. Why will a stock be in a confirmed stage 2 uptrend? See, unless institutions are buying, the stock will not go in a confirmed stage 2 uptrend, right? So that is why I'm not too bothered about institutional buying. I focus on institutional selling. Having said that, if you look at high volume bars, this one and this one, the stock shot up 9% on high volume here. Here, the stock shot up 16% on high volume, right? So, high volume green bar, that's demand. High volume green bar, that's a point in our favor. What else do you see in our favor? Remember, I had spoken about constructive basing patterns having tight price areas, and constructive basing patterns with tight price areas have two characteristics: tight closings, tight spreads. Look at these tight closings: 1, 2, 3, 4. Look at this: 1, 2, 1, 2, 1, 2. Tight closings, right? So you have tight closings inside this base. You also have tight spreads. What is a spread? Spread is the distance between the high and low of the bar. So small spreads here, right? There is no definition of high or small inside the base. It is all relative. So for example, compared to this bar, compared to this bar, or compared to this bar, these bars are displaying small spreads. So you have tight spreads, you have tight closings inside the base. And then of course, next point which is in our favor is it's a proper pattern. It's a properly marked pattern by Market Smith. This is a cup, okay, without the handle, and it has a proper pivot point, which is the high of this bar. It has a selling range, it has a buying range, and it has a stop loss range. Correct? So that's a proper pattern. So how many points in our favor? Roughly 1, 2, 3, 4, 5, 6, 7, 8, 9. See, both of these are the same. So almost 8 factors which look in our favor. Generally, inside the base, the volume remains low. See, the volume remains low. That is a sign of institutional accumulation. Okay. Now, This is one approach. What are the factors which are not in our favor? So you see, you are a professional. You can't be biased in your approach. So you have to look at things which are in your favor and things which are not in your favor, right? So let's look at those factors which are not in our favor. So number one, you see majority of the price action inside the base is in the lower half of the base. So if you notice, if I draw that, if I draw this, if I mark this base, most of the closings 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 out of let's say 15 or 17, 14 out of 17 bars are in the red zone. Red zone means the lower half of the base. Not a good sign, right? So red zone closings, that is not a good sign. The stock has really not spent time in the blue zone or in the green zone. Okay. It's only in this bar that it has crossed the blue zone, entered the green zone. So that is one risk factor which is not in our favor. Okay. That is a factor which is risky, increases the risk in this base. And what is another risk? No handle. So there is no proper consolidation on the right side. The stock has just shot up 16% in a single week. It has created a nice cup without handle pattern, but cup with handle is less risky than cup without the handle. Okay. No price action in green zone. So there could be some overhead supply coming from here. So no price action in green zone. That is another factor which is not in our favor, right? What else do you see which is not in our favor? Extended price. See, although the base reset has happened, it's early stage. But look at the stock before you are buying the stock. It has already shot up 225%. Generally, when the stock comes up from the low, it should go up like 30%. The prior uptrend should be 30%. The relative strength and the volume should be increasing. That's the basic criteria before a cup with handle or a cup without handle. In this case, the prior uptrend is not 30%. The prior uptrend is 225%. So the price is already extended, which adds to the risk in this particular stock, right? So those are the risk factors that I see immediately. There could be more, but I am not able to perceive them right now. But this is what I see. This is which is very obviously, it's very obvious. I can see that happening. Okay. So around 8 factors in our favor, 4 factors not in our favor. So you can clearly see that there are more factors in our favor than there are factors which are not in our favor. That gives us the advantage. That is called the edge or the professional trader's edge. If you read Mark Douglas's book, Trading in the Zone, he talks about developing a trading edge. This is the edge where majority of the odds are in your favor. And obviously, when you do filtering, shortlisting, stock selection, you are doing 5 kinds of analysis on the stock: liquidity, comparative, technical, fundamental, and market. I'm assuming you check that before you look at if you, before you do all this analysis. I'm assuming you do all of that. So that again stacks the odds in your favor. That's the best we can do as a professional trader. So this is the professional trader's approach. Okay. Having said this, what is your next step? Well, the next step is to decide what your position size is going to be. Let's say it's 10%. So you decide that you want to put 10% of your portfolio in this stock when it enters the pivot range. So we will do that. And then what is your next step? To plan the trade. What's your trade management plan? Well, you will sell 1/3 when it goes into the green zone. You will sell another 1/3 when it closes below the 10-week simple moving average on low volume. You will sell the remaining one third when it again closes below the 10-week simple moving average on low or high volume. So you will sell three times. Okay. That's your basic trade management and trade execution plan. It cannot get more simpler than this. Okay. So I will remove this. I will remove this. So time to draw the pivot range. So I have my old school calculator here. What's the high of that bar? 269.40. So let's draw the pivot range. So this is 269.40 and this is 5%. So 1.05 times 269.40, 282, 283. Okay. And that's your buying range. Let's draw the selling range. So 269.40, which is the high of this 269.40, correct? Multiplied by 1.20, which is 323. And 269.40 multiplied by 1.25, which is 336. Done. Let's draw the stop loss range. 269.40 multiplied by 0.92, which is 247. And 269.40 multiplied by 0.95, which is 255. That's it. You are done with buying range, selling range, sorry, stop loss range and selling range. Let's execute the trade. So Monday you get the, sorry, you have to look at volume. Yeah, before the breakout, what's the volume, average weekly volume? It is 1.9 million. So roughly 2 million. So 2 million divided by 5. So 400,000. So on Monday, you should be expecting 400,000 volume coming in because the average weekly volume is 2 million. 2 million on in 5 days. So 2 million divided by 5 is 400,000 shares traded. So on Monday, the next week, we are expecting the price to touch the pivot on high volume. High volume is volume above 400,000 shares traded on a Monday. And look what happens on Monday. Monday, the volume is 1.85 million. How much are we expecting? 400,000. How much are we getting? 1.85 divided by 0.4. We are getting 4 times more volume than what we are expecting. That's like 300% more than what we are expecting, right? Is that a high volume breakout? Of course. Is the price closed above the pivot point? Yes, of course. So will you buy 50 shares or will you buy 100 shares? I would buy 100 shares here. So let's say you plan to buy 100 shares depending on your position size, whatever you planned. Let's say you want to buy 100 shares. Normally we would buy in three tranches, right? 50, 30, 20. But when you see extraordinary volume, like 300% more than what you are expecting to achieve uh, during that week, the volume has already touched the blue line on the weekly time frame chart on Monday itself, and you still have Tuesday, Wednesday, Thursday, Friday to come. So obviously, this is going to be a high volume week. So one approach is to pick up all your shares because you are looking at extraordinary volume. You might expect the stock to hit the green zone in the same week as well. So one approach is to pick up all your 100 shares. Another approach is, since it is just Monday, the week is just starting, there is a risk that the volume might increase, but the price might come down. So you buy 50 shares. Choice is up to you. I would personally pick up all 100 shares because it's extraordinary volume. Okay. And notice this is not some small distance being traveled on high volume. This is 10% in a single day. Okay. Moreover, look at the high of this bar, 254. What's the low of this bar? 257. Is there a rising window between these two bars? Of course. How often do you see a rising window on a weekly time frame chart? Very seldom do you see that happening. You don't see windows on a weekly chart. So this is a rare occurrence. Okay. And it's a positive occurrence. Rising window tends to becomes tends to become support. Okay. And you can see that on the daily time frame chart. You see, this is Monday. That's 1.85 million volume that I was talking about. And you see between these two, there is a gap. Okay. That there is a rising window. There is a difference between gap and window. Gap is a Western technical analysis terminology. Gap is not the same as a window. Window is where there is a proper price vacuum between the low of this bar and the high of this candle, right? So a rising window becomes support. A rising window is a very bullish sign. And that too, it occurs on a weekly time frame chart. Hopefully by Tuesday, Wednesday, Thursday, Friday, it doesn't close. So the gap doesn't get closed or the window doesn't get closed. So let's say you pick up 50 shares, it goes up, more volume coming in, 4.12. You are expecting how much? Another 400,000. So your total expectation is 800,000 by Tuesday. You are getting 4 million. So it's like 5 times, maybe 6 times what you're expecting. Just do the calculation, just do the mathematics. And the price is already beyond the pivot range. So there is a good chance that on Tuesday, you pick up the remaining 30 shares and another 20 shares. So you buy in 50, 30, 20 in 3 tranches. Okay. Now it is just a matter of moving the price forward. Now here the price enters in the green zone. So you end up selling 1/3. Okay. So how much do you make on that stock? So let's say your average execution price is somewhere here, closer to the pivot point because you bought 50 shares closer to the pivot point, somewhere here, and you sold somewhere here. So roughly 20% return on 1/3 the amount of shares that you bought. So on 3.33% of your portfolio, you make 20%. Now let us wait for a close below the 10-week simple moving average. Let's see when does it close below that. Yeah, see, here it closes on low volume below the 10-week simple moving average. So you sell another 1/3. So from here till here, that's roughly 10%. Yeah, 10% return. So you make another 10% on 1/3. You made 20%, another 1/3, you made 10%. See, by the time you sell here, your stop loss is already at break even. Okay. And there is a good chance that uh, when you sell here, your stop loss comes to break even. And if your break even is here, you would probably be out of the trade entirely in this week. So probably you might not get a chance to reach here. You understand what I'm saying? If you look at this bar, see when you buy in this week, okay, you pick up your 100 shares, the stock enters the green zone, you sell 1/3, you make 20% on 1/3 of the position. When you sell partially, your immediate response should be to move your stop loss to break even because you don't want to lose money on the remaining 2/3. So if you look at this bar, assuming your average execution price is inside the blue zone, there is a good chance that this bar will kick you out of the trade. Okay, so let's assume that happens. So you have made 3.33% of your, you have made 20%. So 3.33% multiplied by 20%, that is what you made, which is 3.33 divided by 100 multiplied by 20. So 0.66%. Sorry. This is the amount of money that you have made on a portfolio level from one stock in how many days? In just a couple of weeks. 2, 3. In just 2 to 3 weeks, you made 0.66% on your portfolio, which is a very good return, by the way. Okay. This is not your return on your position, it's a return on your portfolio. Okay. So, the disadvantage of moving your stop loss to break even, which is a very conservative approach, the disadvantage is that you get kicked out of the trade because on the remaining two-thirds, you are just coming out at break even. The advantage of moving your stop loss to break even is that you don't lose money on the trade, right? After this bar, the stock went up. But what if after this bar, the stock would have collapsed? If that would have happened, you would have lost money on the trade. So there are pros and cons to every approach. See, this is a conservative approach. A more aggressive approach would be you buy here and you decide that unless the stock closes below the 10-week simple moving average, you are not going to sell. Okay. That is when you get an opportunity to sell here. Problem with that approach is you only end up making 10% on your trade. So you see the pros and cons of any trade management plan. Before you decide that you want to follow a trade management plan, you should understand what are the pros and cons of that trade management plan. We got kicked out on this stock on the remaining two-thirds of the position. We never got an opportunity to reach here. In hindsight, everything looks fine, but in practical, real life trading, this is what happens. And it's not a problem. It has happened so many times to me. The stock comes down, kicks you out of the trade, and then it starts to go up. If you notice here, the stock continues to go up. But before going up, it kicks you out of that trade. Okay, because you have moved your stop loss to break even. So it is up to you how risky or less risky your trade management approach is. There are some traders who might say, I will not respect this green zone. I will just keep the stock as long as it remains above the 10-week simple moving average. There are some traders who might say, I will sell half here and I will keep the remaining half as long as it remains above the 10-week simple moving average without even moving my stop loss up. So if you're not moving your stop loss up, you actually end up making money on the remaining half as well. But the problem with not moving your stop loss up is that what if the stock collapses? You not only lose money on the remaining half, you also risk losing your realized gain. So your losses will eat into the gains that you have made on the first half of your position. Okay. So I follow that golden rule. Whenever I do partial selling, I move my stop loss to break even because I don't want to lose money on the remaining number of shares that I am holding. So the risk comes from your trade management plan. How conservative or aggressive is your trade management plan? If you decide to move your stop loss to break even, that's a conservative approach. If you don't decide to move your stop loss to break even on a partial sell, that's an aggressive approach. So risk comes from trade execution. Risk comes from trade management. Risk also comes from your filters. The more lenient your filter, the more risky is the trade. The more tight your filters, the less risky is your trade. Risk also comes from the quality of the base. So as long as you understand where is the risk coming from, filtering, quality of the base, the characteristics of the stock, the style of your trade execution, and your trade management plan, at every point in time, you're dealing with risk. That is why I say that you are a risk manager. You are not a trader. Thank you so much.